Over the past few months, I've started a series on my channel where I analyze and discuss companies that are suggested by you, the viewers and subscribers. And what I really love about this series is that it consistently introduces me to new companies and widens the breadth of my knowledge about the stock market and different companies. So the company we'll be discussing today is one that I pretty much have never heard of before making this video or before doing the research for this video. And that company is Coherent Corp, ticker symbol COHR. Now, the recent history of Coherent is a little bit confusing. So originally it was a company called 26. And that company in and of itself is a little confusing to me because it's spelled II-VI. But I believe that's pronounced 26 as in the Roman numerals because the company was named after groups 2 and 6 on the periodic table because that's the groups that contain the specific elements that that company was involved in basically producing originally when it was founded in the 1970s. Anyways, in July of 2022, the company acquired another company called Coherent, but then they decided to take on the name of Coherent for the whole new company, which is also a little bit weird that they would take on the name of the company that got acquired. But enough of that. What does this company really do? Primarily, they design and manufacture various optical materials and semiconductors, with lasers being a large part of that. Their business segments are networking, materials, and lasers, and their products are reasonably technical, so I won't go into too much detail about them here, but there's really a lot of information and detail about all those different products in the 10K annual report. They split each segment into a few business units, and then they lay out what kinds of products that the business unit sells. They also include some general information about their customers in each of the business units and provide specific names of the customers as well, though they say it's not an exhaustive list because some of the customers have confidentiality agreements with Coherent. And then finally, they also list specific names of what they deem to be their top competitors. So overall, I think there's actually a lot of information about the business in the 10K report, which sometimes I feel like there's not a ton of information about the business and I can't get a good idea of what the business really does. But in this case, there's really a lot of information there and you can really get a good understanding of what the business does. So I would definitely highly recommend you read some of that to get a better understanding, because it would take me a long time to go into all those details in this video. So in terms of how the business is doing, it really doesn't look too hot to me. First of all, the company has been squarely unprofitable since the merger/acquisition happened last year. Looking at the fiscal 2023 income statement and comparing that to the fiscal 2022 income statement, we can see that some of their expenses are really ballooning, which caused the bottom line to go into the red. It's also a little bit tricky to compare these numbers to 2021 and 2022 because those 2021 and 2022 numbers aren't adjusted to include both companies. But we can see that because of the acquisition, revenues increased by about 56%, but some other expenses like cost of goods sold and SG&A expenses more than doubled from 2022 to 2023, and then also combined with some restructuring charges in 2023 and a more than doubling of interest due to the debt they took on in the acquisition, and then also more than doubling of preferred stock dividends paid. They lost over $400 million in 2023 compared to net earnings of $167 million in 2022. And looking at the first fiscal quarter of 2024, which is the 3 months ended September 30th of 2023, results don't look really any better. Revenues for that quarter were just over $1 billion, and that was down about 21% year over year. Expenses were down as well, but they were not down quite as much as revenues. So the net loss was even greater in the first quarter of fiscal year 2024 at a total of $98 million loss. The company did provide also a lot of outlook and guidance in their press release, but most of that guidance was for some non-GAAP metrics, which I really usually don't like to see all that much in terms of I don't like seeing guidance or tons of guidance because the company is too focused on providing direct numbers and then just doing whatever they can to meet those numbers in the future. And then also, I don't really like seeing tons of non-GAAP numbers talked about because oftentimes managers will say, oh, there's one-time charges, so we're going to talk about some non-GAAP numbers this year and stuff like that. But it seems in some of those cases, like those companies seem to be always having one-time charges, and eventually you come to the conclusion that they're just having a lot of one-time charges that end up happening all the time, and then that's really hurting their business over time. So that's one of the things that really kind of turns me off when looking at a press release like this, even if the numbers look good or there's nothing glaringly wrong. Just the way that the management is presenting the information is not something I like to see. Another thing they mentioned is that they do expect this past quarter to be the low point in terms of their gross and operating margin, and they expect that to improve in the coming quarters. So we'll see if that prediction does come true over the next few quarters. And talking about kind of their long-term growth plans and prospects, I really don't know a ton about that, and if they're expecting some huge growth over the next few years. But I think that would certainly have to happen, or something would certainly have to happen if the business is kind of going to turn around some, because so far it doesn't really look like this acquisition is working out too well. And because of the losses right now, like I mentioned, the company is going to have to perform really well over the next few years at some point for an investment to be actually worth it. So taking a look at their balance sheet now, we can see they have a pretty decent amount of cash on hand, almost $1 billion, which is actually a significant amount of their balance sheet. The one thing that I don't really like as well is the higher level of inventories, over $1 billion there. And if we think back to the $1 billion of revenue in Q1, they have right now more inventory than revenue that they typically have in a whole quarter, which means they just have a lot of materials lying around idle for kind of a longer period of time, and that capital isn't really doing anything. I know they have had supply chain issues in the past, in the last few years, like many companies, but definitely this kind of company would have those challenges more pronounced. So maybe they have been kind of building up those inventories so that they are better prepared for any future supply chain disruptions. I'm not really sure if that's the case, but that's definitely something I would keep an eye on in the future when looking at their balance sheet. In total, their current assets are just over $3 billion, which is almost 3 times their current liabilities of $1 billion, which at first glance is actually a pretty positive sign for their balance sheet and makes their balance sheet look pretty strong. But I think that outlook kind of changes when we go down and look at the debt. Currently, they have just over $4 billion in debt, which is a lot, really, considering the maximum net income they've had in the last few years was $280 million, which was in 2021. And right now, as we saw, the company doesn't even operate profitably. But if we look at debt in a little bit of a different light, using the debt to equity ratio, it really doesn't look all that bad. Right now, their shareholders' equity is about $4.8 billion, which means their debt to equity ratio is actually less than 1, which is a reasonably positive sign, actually. So there's also some other interesting items on the balance sheet that I want to take a look at. The first is called mezzanine equity, which I've actually never heard of before, but from doing some quick research, it looks like a financing method that's sort of a hybrid between equity and debt. And in this case, it's basically a form of preferred stock that's listed here as Series B preferred stock. They also do have a Series A preferred stock listed under shareholders' equity, but those shares were actually converted to common stock at the beginning of the first quarter of fiscal year 2024. Generally speaking, I don't like to see preferred stock on a company's balance sheet because it's typically more expensive than debt. But Coherent's Series B preferred stock that they still have outstanding only pays a 5% dividend, which generally speaking is pretty low for preferred stock. And right now, it really isn't any more expensive than new debt that they could take on. The issue is with preferred stock that when the Series A shares were converted, that diluted existing shareholders of common stock by about 10 million shares. And looking at the Series B stock, if that preferred stock is converted to common stock, which it could be at some point, then that would add an additional 27 million shares to shares outstanding, which would dilute current common stock shareholders even more. So overall, I'm not really the biggest fan of their preferred stock financing. And then when we add to that their high debt load, I'm really not very confident at all in the strength of Coherent's balance sheet. Plus, they're currently losing money, so if anything, they're just going to have to borrow more money or issue more common or preferred shares to continue operating. Usually, the next thing I would talk about here is dividends, but Coherent doesn't pay a dividend at all on their common stock, which is honestly a good thing since they currently aren't earning any profits So they just have to pay that dividend out of their cash position or take on debt to do that. Something I always look at as well for a company when I'm analyzing them is their valuation. But that definitely gets a little bit tricky for an unprofitable company. So the first metric I usually look at is the price to earnings ratio, but that's really absolutely meaningless when a company has negative earnings like Coherent does. My typical next step would be to perform a discounted cash flow calculation, but Coherent has pretty low free cash flow, and it really isn't very well correlated with their net income, which is kind of one of the requirements for accurately predicting future free cash flows. So that discounted cash flow calculation won't be useful either. One metric that could be a little bit useful is the price to book ratio. And if we look at book value per share for Coherent, it actually looks pretty promising. It has been growing fairly steadily, as we can see, over the past 12 years. And right now, the company's price to book ratio is at 1.04, which means that the company is being valued in the market at pretty much the same amount as their total net worth. But one thing to keep in mind here is that if we look back at the balance sheet, the goodwill and intangible assets line items total to over $8 billion, meaning that were it not for these intangible assets, the company's net worth would really be less than zero. So even though the price to book ratio is right about 1 and makes the valuation look kind of attractive, I think it's pretty misleading right now because all their book value and more is made up of intangible assets. And realistically, those intangible assets are worth absolutely nothing if the company can't make any profit. So as you might have figured out at this point in the video, I have pretty much no interest in investing in Coherent stock. I think they have pretty interesting and useful products that will likely grow in their application and demand in the coming years, but the company really has a poor financial position right now, poor operating results, and I think the Coherent acquisition was probably not a good move for the two companies. I'm honestly surprised how little I like this company because I can usually find some positive things in a company, but aside from their products, I really can't find much else that excites me. And ultimately, no matter how good a company's products or services are, if the management is making poor decisions, then the business is ultimately going to fail. But like I said, I'm really not all that familiar with Coherent as it's a pretty new company for me. So if you think I maybe overlooked something in my analysis that you think is important, that maybe makes the company look more attractive, then please let me know. I would love to learn more about the company and be proven wrong maybe. And as always, if you are interested in chatting with myself and other long-term investors on a daily basis, make sure to join the free Discord server, which will be linked in the description. Thanks for watching to the end of the video. I really do appreciate it, and I'll see you all in the next one.